The US dollar saw aggressive and fast-paced movement across nearly all major currency pairs following the release of the latest non-farm payrolls report. Leading into the data, markets were already on edge, with traders anticipating volatility due to the importance of labor data and shaping Federal Reserve expectations. When the NFP numbers were released, they confirmed a key theme that has been developing over recent months. The U.S. labor market remains resilient. Job creation came in stronger than forecast. Wage growth held up, and the unemployment rate showed no meaningful deterioration. This combination sent a clear message to the market. Despite tighter financial conditions and elevated interest rates, the U.S. economy is still absorbing pressure better than expected. Immediately after the release, volatility surged. USD pairs reacted within seconds as algorithms and institutional traders adjusted positions. Euro to US dollar and pound sterling to US dollar sold off sharply as dollar demand increased, while US dollar to Japanese yen pushed higher as US Treasury yields jumped. The initial moves were fast, emotional, and largely driven by positioning rather than careful analysis. This reaction reflected a shift in expectations. Prior to the report, parts of the market were leaning toward earlier rate cuts, pricing in the possibility that labor conditions were finally cooling. The NFP data challenged that narrative. Strong employment data reduced the urgency for the Federal Reserve to ease policy, forcing traders to reprice interest rate expectations almost instantly. As the first wave of volatility faded, price action entered a second phase. Instead of fully reversing, many USD pairs began to consolidate in the direction of the initial move. This signaled that the reaction wasn't just a knee-jerk spike, but a broader confirmation of the existing trend. The dollar maintained strength, supported by rising yields and renewed confidence in U.S. economic stability.
Are you a skilled trader looking to take your trading to the next level? Meet Funded Folk, the platform that gives talented traders real capital to trade with. No personal risk, no limits, just your strategy and the freedom to grow. At Funded Folk, traders are evaluated based on their skill and strategy, not how much money they already have. Pass the evaluation, and you'll gain access to a fully funded account. That means you can trade with real capital, scale your profits, and focus on what you do best.
From a technical perspective, several pairs broke key intraday levels during the release. Liquidity thinned out, spreads widened, and stop-loss clusters were triggered, amplifying the move. This is a classic NFP reaction, where momentum builds rapidly and price overshoots before settling into a more structured trend. Market sentiment following the release became more cautious. Risk assets struggled to gain traction while the dollar remained bid. Traders began shifting focus away from short-term pullbacks and toward the bigger picture, a labor market that continues to give the Fed room to stay patient. Looking ahead, this NFP report reinforces a crucial point. Labor data remains one of the most powerful drivers of USD volatility. As long as employment remains strong, the dollar is likely to find support, especially during periods of uncertainty or weak data from other economies. However, the story doesn't end here. Markets will now closely monitor upcoming inflation figures, wage data, and Federal Reserve commentary. If inflation remains sticky alongside a strong labor market, expectations for higher-for-longer rates could intensify, keeping USD volatility elevated. For traders, this move serves as a reminder of how quickly conditions can change during major data releases. Preparation, risk management, and awareness of key economic events remain essential. As long as labor strength continues to back the broader economic trend, sharp moves in the dollar are likely to remain a defining feature of the market.